I'm Stephen Clarke, and right now, silver is entering a critical phase. Silver is doing something that often confuses traders. It's quiet, but not weak. Right now, prices are hovering in a tight range, barely moving. On the surface, it looks like nothing is happening. But when markets go silent like this, it usually means pressure is building underneath. Just recently, silver experienced a sharp drop, a sudden move that wiped out several dollars in a very short time. That kind of volatility doesn't disappear overnight. It transitions into consolidation. And that's exactly where we are now. The market is pausing, and this pause is critical. Because silver isn't just reacting to one factor. It's caught in a crossfire of macro forces. On one side, you have a strong US dollar and rising rate expectations pushing prices down. On the other side, you have long-term supply shortages and industrial demand quietly supporting the market. So what happens next? Move forward, because what's coming could define silver's next major move. Let's break down what actually triggered that sharp drop in silver, because this wasn't random. The biggest force behind it was the strength of the US dollar. When the dollar rises, silver instantly becomes more expensive for international buyers. That slows down demand almost immediately. At the same time, expectations around higher interest rates started creeping back into the market. And here's the key issue. Silver doesn't generate yield. So when interest rates are expected to stay higher, investors start shifting toward assets that actually pay returns, like bonds. That creates pressure on metals like silver. But that's only one side of the story. Because even while prices were falling, something else was happening underneath the surface. Something most people completely ignore. Move forward. Because the real story isn't the drop. It's what held silver from collapsing further. Despite all that pressure, silver didn't break. And that's extremely important, because when a market faces strong negative forces and still manages to hold key levels, it tells you there's hidden strength. That strength comes from physical demand. Globally, silver is still in a supply deficit. For multiple consecutive years, demand has been exceeding supply, especially from industrial sectors like solar energy, electronics, and electric vehicles. And this isn't slowing down. In fact, the green energy transition is increasing silver demand at a structural level. Every solar panel, every advanced chip, they all need silver. So even when traders sell in the short term, long-term buyers are quietly stepping in. This creates a floor under the market. But here's the catch. Having strong fundamentals doesn't mean price goes up immediately. Move forward, because in the short term, silver is still trapped in a technical battle. Right now, silver is stuck in what traders call a range-bound environment. That means the market is moving sideways, bouncing between support and resistance without a clear trend. On the downside, there's a strong support zone where buyers have stepped in multiple times. Each dip toward that area has been absorbed. On the upside, there's resistance, where selling pressure increases and stops rallies from continuing. This creates a tightening structure, and when that happens, it usually leads to one thing: a breakout. But here's where it gets tricky. The direction of that breakout is not determined by charts alone. It's driven by macro triggers, things like the US dollar, interest rate expectations, and geopolitical developments. So right now, silver isn't choosing a direction. It's waiting. Move forward, because the next move won't be technical. It will be driven by global events. If you want to understand where silver is heading next, you need to watch one thing above everything else: the US dollar index. Right now, silver is moving almost inversely to the dollar. When the dollar strengthens, silver struggles. When the dollar weakens, silver finds room to rise. It's that simple. But here's what makes this moment critical. The dollar is sitting at a strong position. If it continues pushing higher, it could apply steady pressure on silver, even if fundamentals remain strong. But if the dollar starts losing momentum, that could be the exact trigger silver needs to break out of this range. This is why experienced traders are not just watching silver charts, they're watching the dollar first. Move forward, because another market is quietly influencing silver more than most people realize. That market is oil. And right now, oil prices have been extremely sensitive to geopolitical developments. When oil rises sharply, it pushes inflation expectations higher, and that creates a ripple effect. Higher inflation means central banks may keep interest rates elevated for longer. That strengthens the dollar, and once again, that loops back into pressure on silver. So even though oil and silver seem unrelated, they're actually connected through macro policy. This is what makes the current environment so complex. Silver isn't reacting to one variable. It's reacting to a chain reaction. And until that chain stabilizes, expect unpredictable moves. Move forward, because now we need to talk about what the big players are doing. Let's talk about smart money, because while retail traders are trying to guess direction, institutions are positioning strategically. They're not chasing price, they're waiting. In range-bound markets like this, large players often accumulate quietly. They let volatility shake out weak hands, while slowly building positions in the background. This creates a hidden layer in the market. Prices may look flat, but positioning is changing. And when enough accumulation happens, the breakout becomes explosive. This is why periods of low volatility often come before big moves, not after. So the real question is, are institutions preparing for upside or protecting against downside? Move forward, because the answer lies in the key levels everyone is watching. Right now, silver is trading inside a critical zone. On the downside, there's a level that has been tested multiple times and held. That's your support. If that level breaks cleanly, it could trigger a cascade of selling, opening the door to a deeper correction. But on the upside, there's a resistance zone that has repeatedly stopped rallies. If price breaks above that area with strong momentum, it could signal a shift in sentiment, from cautious to bullish. So this is not just a range, it's a decision zone. And markets don't stay in decision zones forever. They resolve, move forward, because now we're going to map out the two scenarios that could play out next. There are two paths from here. Scenario 1, bearish continuation. If the dollar strengthens further and rate expectations remain high, silver could break below support. That would likely trigger a fast move downward as traders exit positions and momentum builds on the downside. Scenario 2, bullish reversal. If the dollar weakens or macro sentiment shifts, silver could break above resistance. That would force short sellers to cover, adding fuel to the move and pushing prices higher quickly. And here's the reality. Both scenarios are valid right now. That's why the market feels uncertain, because it hasn't chosen a direction yet. But when it does, the move is unlikely to be slow. If you want to stay ahead of these shifts, make sure you're following the Mercer brief. Move forward, because the final phase is where everything comes together. One of the most misunderstood factors right now is geopolitics. Normally, rising tensions push investors towards safe haven assets like gold and silver. But this time, the reaction has been different. Instead of boosting silver, geopolitical stress has pushed oil prices higher. And that creates a chain reaction. Higher oil means higher inflation expectations. And when inflation rises, central banks become less likely to cut interest rates quickly. That strengthens the dollar. And as we've already seen, a stronger dollar puts pressure on silver. So ironically, the same geopolitical tensions that should support silver are indirectly working against it in the short term. This is why the market feels confusing, because multiple forces are pulling in opposite directions at the same time. If you want clear, no-noise breakdowns like this, make sure you subscribe to the Mercer brief. Move forward, because the next phase could be where volatility returns fast. Now let's talk about something most retail traders don't watch closely, but professionals do: the futures market. Because while spot prices show you what's happening on the surface, futures markets reveal positioning. Right now, a key moment is approaching: the futures delivery cycle. This is where contracts can turn into actual physical demand. And here's why that matters. If there's tightness in physical supply, it can create unexpected price reactions. Traders who are short may be forced to cover quickly, which can trigger sharp upward moves. But if supply remains comfortable, then nothing happens, and the market continues drifting sideways. So this isn't just another technical level. It's a potential stress point. Move forward, because there's another signal quietly flashing in the background, and it's been widening. That signal is the gold to silver ratio, and right now, it's expanding. What does that mean? It means silver is underperforming gold. Whenever this ratio rises, it tells us investors are favoring gold as a safer asset, while silver is being treated more like a risk asset. And that distinction is critical, because silver has a dual identity: part precious metal, part industrial commodity. So when markets become uncertain, gold attracts safety flows, but silver gets caught in between. That's exactly what we're seeing right now. The widening ratio is a sign that confidence isn't fully there yet for silver to outperform. But historically, extreme expansions in this ratio don't last forever. Move forward, because when this trend reverses, silver tends to move fast. Now let's shift to something even more important: market psychology. Because right now, traders are divided. Some believe silver is forming a base, preparing for a move higher. Others see this as a continuation pattern, a pause before another drop. And when the market is split like this, volatility increases. Why? Because positioning becomes fragile. If prices start moving in one direction, the wrong side gets squeezed quickly. This is where sharp moves come from. Not slow trends, but sudden reactions. And that's exactly the type of environment silver is entering right now. Low movement doesn't mean low risk. It often means the opposite. Move forward, because there's a hidden pattern forming on the charts that traders are watching closely. Technically, some analysts are pointing to a potential bear flag structure. This is a pattern that forms after a sharp drop, followed by a weak sideways recovery. If this pattern confirms, it could signal another leg lower. But here's the key detail most people miss. Patterns don't move markets. Catalysts do. A chart setup only plays out if macro conditions support it. So even if the structure looks bearish, a sudden shift in the dollar, interest rate expectations, or geopolitical sentiment could invalidate it instantly. This is why trading purely based on charts in this environment can be dangerous, because the real drivers are external. Move forward. Because despite all this uncertainty, there's one thing still supporting silver underneath. That support comes from something long-term investors are watching very closely: the structural deficit. For years now, global silver demand has been exceeding supply. And this isn't a temporary imbalance. It's being driven by real-world demand, especially from industries that are expanding rapidly. Solar energy alone is consuming massive amounts of silver. Add to that electronics, EVs, and advanced technologies, and you have a demand profile that continues to grow. Meanwhile, supply isn't keeping up at the same pace. This creates a long-term foundation under the market. So even when prices fall in the short term, there's underlying accumulation happening. And that's what makes silver different right now. Weak on the surface, but supported underneath. Move forward, because the next move depends on a few key triggers you need to watch closely. At this point, silver is no longer just reacting. It's building pressure. And this is where most traders make mistakes. They either get bored during consolidation, or they take positions too early, without confirmation. But experienced traders do the opposite. They wait. Because markets like this don't reward impatience. They reward timing. Right now, silver is compressing inside a structure where volatility has dropped, but tension has increased. And when tension builds in financial markets, it doesn't release slowly. It snaps. Move forward, because there's a very specific signal that will tell you when that snap is about to happen. That signal is momentum, not price. Momentum. Because price can move sideways and still hide underlying strength or weakness. But momentum reveals intent. If silver starts pushing higher with increasing volume and stronger follow-through, that's your first sign buyers are taking control. On the other hand, if rallies become weaker, shorter, and quickly sold into, that's a sign sellers are still dominant. This is how professionals read markets, not by guessing direction, but by observing behavior. And right now, behavior is neutral, but fragile. Move forward, because fragility in markets doesn't last long. Let's step back for a second, because it's easy to get lost in short-term movements. Yes, silver is facing pressure right now. Yes, macro conditions are creating uncertainty. But zoom out, and the bigger picture hasn't changed. Demand is still strong, supply is still tight, and global trends, especially in energy and technology, continue to support long-term growth in silver usage. This is why long-term investors are not reacting emotionally to short-term drops. They're watching structure, and structure is still intact. Move forward, because now it's time to connect everything together. So here's the full picture. Silver is caught between two powerful forces: short-term pressure from the dollar, interest rates, and macro uncertainty, and long-term support from demand, supply deficits, and structural trends. This creates a market that feels confusing, because both sides are right, just on different time frames. In the short term, volatility and sideways movement dominate. In the long term, the foundation remains strong. And when these two forces collide, that's when the biggest moves happen. Not during trends, but at turning points. Move forward, because this next phase could define where silver goes from here. Right now, silver is at a crossroads, not collapsing, not breaking out, but preparing. And markets don't stay in this state forever. The longer this consolidation lasts, the more powerful the eventual move tends to be. That's why this moment matters. Because the next breakout, in either direction, could happen fast. And if you're not paying attention, you'll miss it. If you want real, no-hype breakdowns of gold and silver markets, make sure you subscribe to the Stephen Clarke. Because in markets like this, information is not just power, it's timing.